Imagine owning a tiny slice of every major US company and waking up 20 years from now to find it built your retirement. No stock picking, no daily panic, just a low-cost plan that grows with America's businesses. That's the power of the right ETFs. In this video, I'll show you the best US ETFs for long-term investing. The ones I'd use as the solid core of a buy-and-hold portfolio with real numbers, real reasons, and exactly how to use them in a faceless, AI-narrated channel like yours. Let's get into it. Quick roadmap. We'll cover a simple core satellite allocation you can adopt today, 8 top ETFs, what they track, costs, and why they matter, how to survive market crises without selling, tax, and rebalancing tips for a faceless channel, and a sample 60-40 style allocation you can edit for your viewers. Part 1. Why ETFs and the core satellite idea. Approximate ETFs give instant diversification, liquidity, and very low fees compared with actively managed funds, which means more of the market's returns stay in your pocket. For long-term investors, a practical strategy is core satellite. Pick 1 to 2 low-cost core ETFs to own most of your portfolio, and add a few satellite ETFs for exposure to dividends, real estate, or growth sectors. The result: broad coverage, lower risk, and still room to tilt toward growth or income. Part 2. The best US ETFs for long-term core. 1. Vanguard Total Stock Market ETF, VTI. VTI aims to track the CRSP US Total Market Index. Large, mid, and small caps across growth and value. So it's practically a one-ticket solution for US equity exposure. It's ultra-low cost and tax-efficient, making it ideal for a long-term core holding. Expense ratio, 0.03%. Use it if you want near-complete US equity coverage in a single ETF. Pros: widest US coverage, lowest cost, excellent tax efficiency for taxable accounts. Cons: mirrors the market, will fall when the whole market falls. Less focus on dividends or quality screens. 2. Vanguard S&P 500 ETF VOO. VOO tracks the S&P 500, the 500 largest US companies. Many long-term investors prefer S&P exposure because it concentrates on large-cap, highly profitable firms. Expense ratio, 0.03%. If you want a simple, historically durable core, VOO is a classic choice. Investor at Vanguard.com. Pros: extremely low cost, narrow focus on large-cap blue chips, massive liquidity. Cons: exclude small and mid-cap gains that VTI captures. 3. Vanguard Total International Stock ETF, VXUS. Voice: inclusive, slightly explanatory. VXUS brings you non-US equity exposure, developed in emerging markets outside the US. For long-term portfolios, international diversification reduces home country concentration risk. Expense ratio, 0.05%. Add VXUS to avoid being 100% tied to US market cycles. Pros: broad international exposure, low cost. Cons: currency and geopolitical risk. Long-term returns have historically lagged the US at times. 4. Vanguard Total Bond Market ETF, BND. Bonds cushion equity volatility. BND tracks the broad US investment-grade bond market, treasury, agency, corporate, and mortgage-backed securities. Expense ratio, 0.03%. For investors wanting a stable ballast, BND, or a fund like AGG, is a fundamental fixed-income core. Pros: broad bond exposure, low cost, income stability. Cons: interest rate sensitivity, returns are lower than equities over the long run. 5. iShares Core US Aggregate Bond ETF, AGG. AGG is BlackRock's version of a broad US bond aggregate. Similar coverage to BND, and also very low cost with an expense ratio around 0.03%. Many advisors alternate BND and AGG depending on personal preference or platform availability. 6. Schwab US Dividend Equity ETF, SCHD, satellite. Income plus quality. SCHD screened for high-quality US companies with a history of consistent dividends. It's a great satellite for investors who want income and some downside cushion. Expense ratio, 0.06%. If your channel wants to discuss dividend strategies, SCHD is a practical, low-cost pick. Schwab Asset. Pros: Dividend-focused, quality filters, strong long-term performance. Cons: more concentrated than broad market funds. Dividend strategies can underperform in certain growth environments. 7. Invesco QQQ Trust QQQ Satellite Growth/Tech Tilt. Voice: excited but measured. QQQ tracks the Nasdaq 100, heavy on tech and growth names. Over the last decade, tech-led growth has driven huge returns, and QQQ captures that exposure. Expense ratio: 0.2%. Use QQQ as a smaller satellite to capture growth, but expect higher volatility. Pros: high growth potential, exposure to large-cap tech leaders. Cons: sector concentration and higher volatility, higher expense ratio than the broad-core ETFs. 8. Vanguard Real Estate ETF VNQ Satellite Real Assets/Inflation Hedge. Voice: steady, explanatory. VNQ invests in US REITs, real estate investment trusts. Real estate can provide income and diversify equity risk, and is useful as an inflation hedge. Expense ratio: 0.13%. Consider VNQ as a small allocation for dividends, diversification of equity risk. Cons: sensitive to interest rates and economic cycles. Part 3. How to build a long-term allocation. Core satellite examples. Here are 3 example allocations you can present to different audience types. Mention their starting points, adjust by age, risk tolerance, and goals. 8. Simple aggressive, 100% equities for young investors. 80% VTI, total market. 10% VXUS, international. 10% QQQ, growth tilt. B. Balanced core satellite, for long-term but risk-aware. Classic long-term starter. 50% VTI or VO, US core. 20% VXUS, international. 20% BND or AGG, bonds. 10% SCHD or VNQ, income/real assets. C. Conservative long-term, income plus preservation. 40% VTI/VO. 40% BND/AG. 10% SCHD. 10% VXUS. Part 4. Surviving market crises. Here's where the human touch matters. Viewers panic when markets drop, but long-term investing is about behavior, not perfect timing. Use lines like, if you're invested for 10+ years, market drops are normal, not a reason to sell and panic. Give the data. Over long windows, equities have a short anecdote. Tell your viewers. In 2008, the market plunged, but those who stayed often saw the recovery. That's the real power of compounding. Don't claim exact recovery times unless you cite specific studies. Keep anecdote qualitative. Part 5. Taxes, rebalancing, and account placement. Practical tips. Tax efficiency matters. ETFs like VTI and VO are tax efficient, good for taxable accounts. Bond funds income is taxed yearly, so place bond holdings inside tax-advantaged accounts. IRA for 401k when possible. Rebalance once or twice a year or when allocations drift more than 5%. It forces discipline and harvesting gains from winners to buy underpriced assets. Part 6. Common mistakes. Tell your viewers to avoid these mistakes. Chasing last year's top performer. Tech hot last year? Don't overweight blindly. Paying high fees. Even a 0.5% higher fee can erode returns dramatically over decades. Overtrading around headlines. Frequent trading often lowers returns. Total market ETF like VTI or an S&P 500 ETF like VO will build the foundation. Then use satellites like SCHD, QQQ, and VNQ to tailor income and growth exposure. All the ETF fees and basic facts I mentioned are linked below, so you can verify them yourself. Like, subscribe,